On September 24th of this year, the US Department of Justice brought a lawsuit against Visa, suing the company for being a monopoly in the debit card market in the United States. If you're a long-term fundamental investor, odds are you either own Visa in your portfolio right now, or you've considered buying the company in the past, but just didn't pull the trigger for one reason or another. That's certainly the case for me. Visa is currently the largest holding in Rated A's portfolio, which is a portfolio that I manage personally. I use Rated A's research and ratings to invest the company's funds, so you can definitely say that we eat our own cooking. And the reason why Visa got to be such a large part of the portfolio in this past year is that pretty much for the whole year, it's been flagged as a good value opportunity. Visa is rated as an A, so it's part of the group of select few companies that I would want to own forever for the long term. But that's only for the right price. And right now, the value rating at 3.87, what that's telling me is that based on Visa's overall quality, which is rated as A, and the current price is a good value opportunity. Usually for stocks that have ratings of 3.5 and above, that means it might be a good timely investment. So Rated A has been accumulating Visa shares in the portfolio, and it's now the largest position in that portfolio. So since the Department of Justice in the US is suing Visa, what I'm going to do in this video is a little refresher on Visa's business and why it's such a good business. We're going to go over the company's moat because especially for Visa, that's not always understood very well. Then we're going to go over the DOJ's full lawsuit. We're going to see what Visa is being accused of exactly and what the potential consequences for the business could be and for the shareholders, us. So starting off with Visa's business model. Everyone watching this video will be familiar with the plastic cards that have the Visa logo on them and that allow you to just tap or swipe to make payments. And whenever we think of Visa, that's usually the first thing that comes to mind is these little cards. That being said, Visa doesn't actually give out those cards or sell them to the consumer. It's the consumer's bank that does that. Visa never actually interacts directly with consumers like you and I. They don't issue any credit and they don't take on any financial risks. Visa is just a network, or in other words, the rails that allow banks to communicate with each other so that payments can happen between us and businesses whenever we buy from those merchants. And at this point, I think it's important to address some key terms that you'll be hearing again and again throughout this video and that you'll be seeing in the lawsuit if you ever read that. Consumers just refers to people like you and I, just normal people. That's pretty self-explanatory. Then there's the issuer, which stands for the issuing bank. And that's the consumer's bank that basically gives them the card. Then on the other side of the transaction, there's the merchant, which is the business that's accepting the payment. And finally, there's the acquirer, which is the acquiring bank, which is just simply the merchant's bank. Visa is simply the infrastructure that allows money to flow from the consumer to the issuer to the acquirer and finally to the merchant. Visa makes money in two main ways. First, they charge a fee to issuing banks whenever this bank issues a new card that is connected to the Visa network. And then they also collect a small percentage of the merchant discount rate, the MDR, which is a fee that is paid from the merchant to the acquirer whenever a transaction happens on the Visa network. So this network is the essence of Visa's business model. They've tried to diversify a bit by going into what they call value-added services, which are basically services that make the network quicker, more reliable, less prone to cyber attacks, etc. But for the sake of this video and to stay on topic, we're not going to discuss those as much. So what's so great about this network? Well, for any business, network effects are the ultimate goal. Network effects is a type of moat or a competitive advantage whereby each new point that's added to a system increases the value of the system for every other point. Network effects are very hard to come by. It's very difficult to get the ball rolling, but once it does, the effects can be spectacular. In industries where network effects are relevant, the market is usually dominated by one or maximum two players. because networks are usually a winner takes all market. By definition, if more points get added to a network and it increases the value of the network, then every point will congregate to that network to maximize the value of it. And that's the beauty of network effects for companies that can achieve them. On the other hand, for companies trying to compete against the network effects, life can be very difficult because it's very hard to convince someone to leave a network with lots of value and to make them come onto your network, which by definition is just starting off, which means that the value there will pretty much be non existent. So, for example, you have networks that are one sided that are often seen in social media. And here, every user adds more value to the network, and that makes the network more appealing to every user, and so more people join. And then you have two sided networks, which are a bit harder to establish than one sided networks, because now you have two participants, and you need to build both parties at the same time. So these networks can be seen, for example, in marketplace platforms like eBay, where you need a buyer and a seller, or like in Airbnb, where you have customers and then you have landlords that are putting their properties on the platform. So, because you need to build both sides concurrently, these two sided networks are harder to establish usually. And then there's the Visa network, which is a four-sided network. Like I mentioned, there's the customer, there's the merchant, there's the issuing bank, and there's the acquiring bank. And it took Visa many decades to establish this four-sided networks. It took some very special circumstances and some luck as well. And the end result is that this network, which is, replicated also by MasterCard, but it's pretty much indestructible at this point, and it's very, very hard to compete against those two companies. If you want to compete with Visa and establish an alternative network, then you have to build up four sides at the same time. That's very expensive for a few reasons. You first have to start with one of the parties. For example, you go up to issuing banks and you ask them to give out cards that have your network on them. But how are you going to incentivize these banks to do that? Visa calls this the chicken and egg problem. Banks won't adopt the network unless many merchants accept it, and merchants won't accept it unless consumers have cards from the network already. And all of this effort would need to result in significantly cheaper alternatives to Visa and MasterCard, since those two are already established and have very deep relationships with the banks and with customers. And if you want more details on Visa's Moat, feel free to go read the Visa business analysis on Rated A. It explains the whole thing in more detail. But for now, just remember that Visa has been extremely profitable in a virtual duopoly with MasterCard, simply because this network is virtually impossible to replicate. Before we dive into the Department of Justice's new lawsuit against Visa, I want to set some historical context and look at the previous lawsuits that have been brought against Visa in the past and how they changed the landscape. Because Visa is a cheat code to make money, and so you bet that governments have tried to break it up or, change the market in the past. The first ever antitrust lawsuit that was brought against Visa and MasterCard is from 1998. And this is a different time when both of these companies were just private entities that were still owned by a collective of member banks. And at that time, both Visa and MasterCard were preventing banks from issuing cards with other networks. And so American Express and Discover were pretty much never on consumers' cards. And so the DOJ came in, broke that up, and now, since 1988, banks have been able to partner with more than one network. The second and most famous lawsuit came in 2010 under the Dodd-Frank Act, which was part of the Durbin Amendment. In this one, merchants actually sued Visa for conspiring with banks to fix the interchange fees. And remember, interchange fees are just part of the merchant discount rate that we discussed earlier, which are the fees that merchants pay to the acquiring bank whenever a Visa transaction happens on the Visa network. These merchants were very angry, and they argued that Visa's fees were too high, and also that Visa was prohibiting them from give incentives to consumers for using cheaper methods of payment like cash, for example. And so for this, Visa and MasterCard had to pay about $7 billion in fines. And since then, merchants have been able to charge more whenever a consumer pays on a Visa network or a MasterCard network. And so this helps then regain the losses that they incur when they have to pay the fee to the acquiring bank. Now, this Durbin Amendment also resulted in a second big change, which is that now issuing banks, whenever they give out a card to consumers, on that card, there has to be at least two unaffiliated networks, which means that every time a transaction is done through this card, the merchant can now have more than one option on which network to use. And by doing this, the regulators were hoping to break up the Visa and MasterCard duopoly and to open the doors for these smaller networks to make it onto the cards of issuing banks. And this way, they could start winning over at least two sides of the network, which is the consumers and the issuing banks. Yet here we are in 2024, and Visa still has 60% of the market share in the debit card market in the United States, and the stock is up 1,400% since then, which is roughly a 13x. And the regulators are back. New lawsuit just dropped, so let's see what this is all about. So, the document first mentions non contestable transactions, which are transactions that, for a number of reasons, have no choice but to be made on the Visa network. For example, these are transactions that are above a certain dollar amount or transactions that have certain encryption criteria. Or, for example, if the network that is used is a PIN network where you have to enter the PIN code in order for the transaction to happen, and the transaction is made in a PIN-less way. So, for example, when you tap the card. In that case, the transaction is also non-contestable. It has to go through Visa. The DOJ mentions in the lawsuit that Visa actually pays issuing banks to not allow PIN-less transactions on PIN networks, which makes these networks not able to compete and increases the amount of non contestable transactions. And then Visa uses these non contestable transactions as leverage to essentially force merchants to choose Visa as the preferred network for the transactions that they accept. So, in other words, Visa says either you sign a contract with us and you route all your transactions on Visa, and we give you a discount on all the transactions, or you can route the transactions as you wish, but on the non contestable ones that have to go through Visa, you'll pay the normal rate, which is actually a much higher rate. In both cases, Visa makes the same amount of money, but for the merchants, it's actually cheaper to sign that deal with Visa and to route all the transactions with Visa. Visa also uses a variety of other strategies, like they mention cliff pricing, to essentially force merchants to use Visa exclusively. And the result of that is best expressed in this point 83 right here on the lawsuit. As a result of Visa's cliff pricing, for a PIN network to win a meaningful set of transactions away from Visa, it must do two things. First, the PIN network must offer a better per transaction price than Visa. Second, and more significantly, the PIN network must also compensate the merchant for the penalty Visa will impose on all the transactions the merchant still has to route through Visa, which is larger than the set of transactions for which the PIN network can compete. To compensate some merchants for the loss of Visa incentives on Visa eligible debit transactions, the PIN network may have to offer zero or negative per transaction prices. These penalties reflect significant and cost prohibitive barriers to expansion for the PIN networks. And that's the first main point that is brought against Visa in this antitrust case. It's that Visa uses its scale and its monopoly profits to bribe and collude with issuing banks and to force the hand of merchants so that the only option is Visa. The second main point is regarding fintech or financial technology players like Apple, PayPal, and Square, which are companies that are specifically mentioned in this case. These tech companies have large networks with endpoints both on the merchant side and the consumer side. And it's possible for these platforms to link directly to the consumer's bank account rather than to a debit card. And so this, in theory, could bypass Visa and cut them out of the transaction. But up until now, consumers are still using debit cards on these platforms, meaning that even when they pay using Apple Pay or PayPal, the transaction is still going through Visa's rails, and so Visa is still collecting their fees. We'll talk about that more in detail in a little bit. The DOJ claims that Visa saw these tech platforms as an existential threat to their business, and that if these tech platforms had network ambitions, they could essentially cut Visa out of the transaction entirely. And obviously, that would be disastrous for Visa. So, in order to dissuade them from starting a new network, Visa either pays them incentives, which are basically rewards for them not to step on Visa's territory, or if they do try to start a new network, Visa cripples them with fees. And the DOJ points to the fact that new and cheaper and faster railways have become available in the recent past decade, such as the RTP network and FedNow, but that these are still way underused and that most transactions still go through Visa. So, to summarize this point, the DOJ argues once again that Visa uses its scale and its monopoly profits to incentivize, whether positively or negatively, these tech platforms to not start a new network. And in the past few years, actually, all three of them signed new long-term contracts with Visa to, lock in that relationship. So, for example, Visa pays Apple hundreds and millions a year in a gentleman's agreement so that Apple never develops a network that can compete with Visa. And in return, Apple gets 100% margin passive income from Visa every year. So now that everything's a bit more clear, we can start talking about the potential consequences for Visa moving forward. First things first, to me, what seems the most certain is that this case is going to take a long time to get resolved. And so we might actually be hearing about this for months, if not years, while Visa's lawyers battle the DOJ in court. And let me tell you, Visa probably has some of the best lawyers in the world. And this is what Visa representatives had to say. Visa General Counsel Julie Rottenberg said the lawsuit is meritless. Anyone who has bought something online or checked out at a store knows there is an ever expanding universe of companies offering new ways to pay for goods and services. Today's lawsuit ignores the reality that Visa is just one of many competitors in a debit space that is growing with entrants who are thriving. When businesses and consumers choose Visa, it is because of our secure and reliable network, world-class fraud protection, and the value we provide. We are proud of the payments networks we have built, the innovation we advance, and the economic opportunity we enable. This lawsuit is meritless and we will defend ourselves vigorously. I mean, that's exactly what I would expect Visa to say at this point. Of course, they're going to defend themselves. At this point, it's too early to say what exactly is going to happen to Visa after this case. But as a fundamental long term value investor, it's my responsibility to be prepared for the worst case scenario. If the DOJ ends up winning the case, there's a few things that I could see happening. The first is fines. It's very possible that Visa will have to pay 1 to 5 or $6 billion in fines based on the company's free cash flow. The likelihood of that happening is relatively high, in my opinion. However, the impact of that punishment could be minor because, like I mentioned before, Visa is a money printer, and any type of one time payment that the company will have to do will probably not be very impactful over the long term. What about a breakup? Well, I don't really see that being feasible because, unlike big tech that has various types of operations, Visa's network is one of a kind. The company runs its debit, the credit, and the value added services all on top of the same network. So, realistically, I don't see how that could be split into different businesses. I think the most interesting thing to consider is what if the DOJ rules that Visa's payments and contracts and the incentives are illegal and anti competitive? And by that, I mean the contracts with issuing banks, with merchants, and the incentives that are paid to would be competitors. The first thing to note is that this would be an incredible boost to profits over the short term. If we look at Visa's revenue structure in 2023, the company spent nearly 30% of its revenues on client incentives. If Visa stopped paying these incentives, then from one day to the next, the company would see its revenues go up by that amount. And this would be extremely high margin revenue because all of Visa's costs are already accounted for. So a lot of this revenue would end up flowing straight down to the bottom line. But that's over the short term. Over the long term, Visa's mode would surely be affected, and the long term impacts on profitability are a lot more uncertain, except maybe not. Here's the way I think about it. It's pretty much a fact that Visa operates the best debit system today based on safety, encryption, reliability, etc. Yes, it's more expensive of a system than other debit alternatives, but it is a lot more trustworthy as well. And in payments, trust means a lot. The DOJ argues that the reason why other networks aren't as reliable and trustworthy is because they lack the funds to innovate and to invest in their networks. Fair enough. But in the government's ideal world, if all networks were to actually start competing and prices came down for everyone, including Visa and MasterCard, it would mean two things. The first would actually be less rewards for consumers on banking products, less cashback, less credit card rewards, etc. Because remember, most of the interchange fees go to the banks, and then Visa gets a cut of that. So that would probably penalize the consumer, which is the opposite of what the DOJ is trying to accomplish here. But the second thing is that because of Visa's scale, they would still be able to offer the most competitive prices affordably. If Visa brings the prices to rock bottom, aka the minimum required for it to be profitable, then there's no way that smaller networks would be able to manage to be profitable at those same levels. And even less probable that they'd be able to invest and innovate their own networks. So the odds of them bringing their rails on par with Visa from a technological perspective would be very low. That's just food for thought. But what about the fintech accusations? Let's try to unpack that. I actually found this super interesting article called Missing Pieces: What the Pundits Get Wrong About the DOJ Debit Interchange Lawsuit Against Visa. I'll leave it in the description of the video so that those of you who are interested can read the full article on your own time. But basically, to summarize what it's saying, when it comes to PayPal, the article says that once PayPal partnered with Visa in 2016, it was actually very beneficial to PayPal. And they went from 2 transactions a month to 3 transactions a month within 2 to 3 years once they enabled the debit card payments using Visa's and MasterCard's networks. Regarding Square, the article mentions that I'm just going to give a quote here. Square was able to build its network on the back of the card networks because they could spend zero money getting the consumer side on board. So, once again, this company was growing very fast and rose to very high valuations, in part because the Visa network was already very reliable. And when it comes to Apple, uh, do we really have to say much? Apple is already the largest company in the world. They're the most powerful company in the world. They have so much cash on hand, so many funds that if they really wanted, they could have started a network. There's really nothing stopping them. And well, what the article is saying, which I agree with, is that do you really think that Apple could be bullied into signing a contract with Visa? It's funny that the DOJ was suing Apple just a few months ago. Granted, it was about something different, but now, Apple is the victim in this lawsuit. Pretty funny. And even if PayPal, Square, and Apple were allowed to compete with Visa and establish a network, it's not even guaranteed that that would be in their best interest. They would have to invest insane amounts of money to get a network as wide and as reliable and as international as Visa's. And once again, we run into the same issues as before. That if pricing becomes a race to the bottom because everyone starts competing and everyone has a network and they're all the same, then why would these companies invest so much when Visa and MasterCard already have an established network? And then something else I find interesting is that in the lawsuit, they are quite repetitive in mentioning that innovation has been stifled because of Visa. Let me read to you this paragraph that I find interesting in the article. Neobanks like Chime, Venmo, and SoFi exist because they create mobile accounts that ride Visa's rails. The $30 billion buy now, pay later sector consists of fintechs that have seen steady growth because they ride debit rails to process payments from borrowers' bank accounts. These players also issue anywhere cards that can be used to create a pay later loan made with purchases anywhere that Visa and MasterCard are accepted. According to a 2024 report by the World Economic Forum and McKinsey, startup funding in the fintech sector grew from 19 billion in 2015 to 33 billion in 2020. Deal sizes more than doubled. Publicly listed fintechs have an aggregated valuation of $550 billion, and the number of fintech unicorns increased 7x between 2019 and 2023. Set aside the 2022 correction, and the report projects that fintechs will grow 15% year over year for the next 5 years, more than double the growth of banks in the traditional sector. Fintechs have used the card networks to build their businesses and eliminate the cost and complexity of creating merchant acceptance from a standing start of no or few users. They also have a choice for which card network they partner with to do that. It is competitive. Who they choose is based on their own business case and company economics. So, all that to say, nothing is black or white. The DOJ paints Visa as an evil company that stifles competition and that is bad for both merchants and consumers. This article, on the other hand, states that pretty much all the innovation that has happened in the financial sector in the past 10 years has pretty much ridden the back of Visa's network. So nobody knows how this is going to end, and the dynamics of this industry are very complex. And it would be presumptuous of me to say that I know exactly how it's going to end. But for now, what I can say is that Visa is staying in Rated A's portfolio. I hope this video was informative, and I'll see you in the next one.